Hi guys, I want to take you through the recap for the trade this week, ending on the 5th of February. So as you all know, we're in a fairly lengthy short, which started on the 4th of February here. Now, as you would have seen, that this is how the hedge works. So remember, I'm always saying that, in case the market really sells off, what's your protection? What's plan B in case the market sells off 3 strike points? Usually you would blow up your options account, but this is the key to staying alive and still making profit. So it's more of a long-term trading system rather than just making extreme amounts of profit in short time and then blowing your account up. So I'll just take you through this short trade again. Now just remember that our strike points, our call positions are up there at 12.10 and our puts are down here at 10.05. So that's where we want the market to stay inside, underneath the red and above the blue. So if at expiry period that the market closes above the blue line there and below the red, we get full options premium. So at the moment it's unrealized profit, and that varies and fluctuates as the market sells off and rallies. So that the last short trade we had was on the 4th of February, so that's triggered there at 10.89.50. Now as soon as our stop goes underneath our green line, that means we're in profit. So this trade is in profit as of there at 9.06. It means we're making money on the way down. So as this market sells off, we're following our stop down on those yellow dots, and that's our trailing stop. So we pull in a fair amount of profit out of this trade. I think it was about 22, 23 points. So we keep going down, and we just stop out here. You might have been lucky and missed the changing of the stop, but I got stopped out. You can see how the high of that candle was 10.64, and our short stop should have been at 10.63.75. So whether you got in or you stayed in that trade or not, it wouldn't have mattered a lot, because you would have been definitely stopped out down here just a little bit later. So in that trade alone, in that short trade, we've made a total of 25.75 points. Now for a $100,000 account, that's 6,500, and as you ratio up in the lot sizes, so every 100,000 is worth 6,500, so you're making 32,000 in that run there on a 500 grand account, and then you make 65 odd in a $1 million account. So just gives you an idea of how it ratios up. So then we go into another couple of trades. We stop out here, so that means there's our point there. So when that happens, when you stop out, you're looking for either another long or a short. So we stop out here in that area there. There's our stop out there. Now to show you again, that's where the candle has gone through our yellow dot, which is our stop. So now we're looking for a long, and we get that long. We don't get a long. As the market closes, we'll see how these long entries slowly move up with the market. So as the market's trending up, well, we need this market to push up through these crosses to be able to get in a long trade. So that doesn't happen. So now we're looking for a short, which we get down here. So there's our short trade there on that candle. So we're short again, and then we're trailing in our stop with the yellow dots. So that comes down at break even. So we get out of break even there because we stop out where we entered. And now we're currently in a long trade. So that is holding long positions over the weekend. So our stop at the moment is coming up to almost break even as well. So that's great. So that takes us, we've been trading this first spread of the year since 4th of January. So we've been going about a month, and the account is up 7.2%. So that gives you an idea of how powerful the system is. Now we'll keep managing this trade as we move along. We may exit out of the options trade at 70 to 80, 90%, but at the moment the futures is done all the damage for the account. It's up at $5,000 and the options is $2,000. So that's where the money has come from for the profit so far, mainly from the futures, which is great. That's part of the system, and that's just a great example today of how it works in periods of a sell-off or a rally. So just remember that our strike point is down here at 10.05, so we're only 50 points away from our strike point. What we don't want to happen is for this market to go down and expire underneath this blue line. That means we don't get any options premium and we're in negative for options. But if we rally, if we sell off down there past the blue line, that means we're making profit on the futures on the way down. So that's the whole point of a hedge. So then our futures profit, if that's a negative number here, well, our futures will be still positive because we had to go down past that territory to get there. So we're taking points on the way down. So that you would have seen how that works from the example on those last three moves. So that's how we hedge, and that's the system. So that's a great example, and I'm happy to be able to show you that. If you've got any more questions, email admin@Key Equity Hedge. Otherwise, have a great weekend.